A very good morning and welcome to the 34th EBRD Annual Meeting and Business Forum here in London, both to those of you joining us here at EBRD headquarters and to our audience online. International Sign Language interpretation is also available for this session. My name is Jonathan Charles. I'm chair of the EBRD Alumni Association. I'm a former member of the EBRD Executive Committee. And today we're looking at the latest economic forecasts across the EBRD regions. Welcome to a world where the rules of engagement we've been used to for so many decades no longer apply. Welcome to a world where the laws which govern trade, security, geopolitics, and drop in the word geoeconomics as well, are being ripped up right before our eyes. Welcome to a world of uncertainty. Navigating all of that is more challenging than it's been for most of our lifetimes. The global economic landscape currently resembles a complex jigsaw puzzle with constantly shifting pieces rather than a stable system governed by predictable rules. Although a full-blown trade war between the world's two largest economies may have been narrowly averted, we'll see, uncertainty still looms. Our projections for the EBRD regions released earlier this morning downgrade growth forecasts for this year by 0.2 percentage points relative to what was predicted just very recently in February. Tariffs and uncertainty about what they'll be and growing global polarization all feed the risks of new inflationary pressure. The risk to financial stability and, of course, rising debt have also increased. Emerging economies are seen as particularly at risk from rising borrowing costs and potential capital outflows. Policy uncertainties reached its highest level in a decade, according to the Global Economic Policy Uncertainty Index, which now stands 35% above pre-pandemic levels. Unbelievable, 35%. Is it the end of the world economy as we know it, to paraphrase an REM song? Do we feel fine? Let's see. Could this reconfiguring world economy, with all of its volatility and uncertainty, actually present opportunities for the countries where the EBRD invests? Here to help us launch our latest regional economic prospects are our economic heavyweights. Lord Jim O'Neill, an economist, former chairman of Goldman Sachs Asset Management, a member of the House of Lords, and a former minister, government minister. Sergey Guriev, next to him, Dean of the London Business School, former EBRD chief economist as well, and the current EBRD chief economist, Beata Javorcik, professor of economics at the University of Oxford. Whether you are watching us here in the audience in the building or online, please feel free to post your questions in the comment boxes or on Slido. The code is 2201242. You can see it up there. And remember as well, on the screen, there it is, pick the tab that says REP 25, REP 25 if you're using Slido. And for the audience here in the building, we'll have some microphones going around a little later on so you can ask your questions in person. Anyway, let's start with an overview of economic growth across the EBRD regions. What's the big picture, Beata? Give us that.
Thank you, Jonathan, and good morning, everyone. The story of the latest regional economic prospects is the story of external environment, of the external turbulence affecting our countries of operations. We have downgraded our forecast by 2 percentage points, and we have downgraded the forecast for each of our regions. And this comes already on top of the downgrade in February. Now, in the case of Central Europe, Baltics, Southeastern Europe, and Western Balkans, it is weaker performance of Germany, weaker demand for exports that's affecting these economies. In the case of Ukraine, the good thing is that the Baltic Sea export corridor is working, so exports are going up. But on the negative side, destruction of infrastructure has led to shortages of power. There are acute shortages of labor, and harvest last year was weaker. Central Asia is the region with the largest, the fastest expected growth, driven by commodity exports. But even here, we can see the impact of turbulence through weaker performance of China and lowering, that would lower prices of commodities. In southeastern Mediterranean, our countries of operations are feeling negative spillovers from two conflicts. And finally, in Turkey, this inflation process, higher interest rates related to political turmoil, to turmoil in the markets, is putting brakes on the economic performance. So overall, it is not a very happy picture.
No, a very pessimistic picture. But if we zoom in on the policy uncertainty a bit, Beata, what are the likely impacts on the EBRD regions, the EBRD countries?
Policy uncertainty is at a record high level. It is higher than it was during the global financial crisis. It exceeds the level we observed during COVID and at the point of Russian invasion of Ukraine. And of course, uncertainty is detrimental to investment. Uncertainty in policy, in economic policy in general, is driven by uncertainty about trade policy, particularly due to recent changes in the US trade policy. To put things in perspective, US tariffs that have been proposed are at the level that was seen last time in 1930, so the infamous Smoot-Hawley tariffs. But the difference is that back then the tariff increase was from a level that was already higher, while now the tariff increase happened from a very low level, so the shock was greater. And actually the impact of uncertainty generated by this trade policy may be higher than the impact of the tariffs we will end up with.
And I think you only have to look at that amazing green line like a vertical wall, don't you, to see exactly what is happening right now in people's minds. I mean, that's quite staggering. So that's the picture in the EBRD countries of operations. But what about the global economy? How does that look? What about the G7 economies and the other big economies that drive the economic picture? Jim O'Neill and Sergey Guriev, perhaps I could turn to you to see how you see it. Jim.
Oh dear.
You're on the spot.
I've no idea.
Well, I think that fits in probably with that uncertainty index.
You know, I was smiling to myself watching Beata show those slides, and then you both implying that they were quite pessimistic. I mean, if the G7 countries got anywhere near those levels of growth, that would be pretty astonishingly surprising. The way the so-called developed world has evolved, this is a little bit of an exaggeration, but in essence, we're talking about the States. You know, most of the G7 countries have very, very low growth trends.
Yes.
And that's even without what seems to be this reoccurring shock, which the shocks themselves feel as though they're getting bigger. And so the growth potential, you know, to expect the G7 to be a source of growth without major policy change is, you know, just, it's not going to happen.
It's interesting, isn't it? You know, I remember, you know, if you think back 20 or 30 years ago, we used to worry if, you know, we talked about the growth engines being America, Europe, and Asia.
Yeah.
You know, and we worried if one of the three was having difficulties. Look at where we are today.
I mean, the flip side, I mean, to put it in another context, and I'm sure we'll come back to this, according to the back of the envelope numbers I was playing around with for something else a couple of weeks ago, I think about 60% of all global growth we've had since the turn of the millennium has come from the US and China. And to a degree, the rest of us are sort of feeding off scraps, although India has obviously become increasingly important. However, in the spirit of never letting a crisis go to waste, and in this sense, I'm a little bit, I guess, conventional as to how many international economists might think about it. This is a chance for the coalition of, let's call it the G7 willing, to learn to stop being so dependent on the US, particularly Germany. And I guess that's a country that's probably really important for your countries. And I find myself thinking that the coincidence of Trump's madness, not, you know, not to disguise my views.
Other views are available, by the way.
The coincidence of that coming straight after the sort of domestic madness going on politically in Germany, actually is not a bad thing. And it looks like it's going to be tricky, but it feels to me Germany's going on a different path, which I'd be amongst those economists that would say that Germany should have done that the past 20 years.
Yes, yeah.
And at the end of the day, I used to argue this back in my Goldman days with the one and only Peter Sutherland, the ex-head of the GATT, that relative rates of domestic demand growth are ultimately more important for global trade than most trade policies. Not these scale of uncertainties, but I think if you get Germany, and again, we'll come back to it, if you get Germany and China wanting to live more off domestic demand, then that's not a bad outcome, I think, for some of your countries, myself.
Yeah, and also actually that doesn't, we may come back to it later, that raises the question about whether China and Europe cooperate in some closer way, which also plays into that. Sergey.
Yes, I fully agree with Jim. I think there is huge policy uncertainty, but China has prepared itself. China, this time around, unlike 8 years ago, expected a new trade war and tried to think about more resilient supply chains and other markets. Germany is an important moving piece. We still don't know where it lands, but it looks like Germany will add a major component to the global demand. We are thinking about hundreds of billions of dollars in the range of half a percentage point of global GDP over the years, not next year, but maybe even a 1 percentage point of global GDP. So this is an important change, and it is an unprecedented shift. So, and I think the other important reason for cautious optimism is that this administration, US administration, has shown that it can reverse course in reaction to markets panic, which is, I think, cautious optimistic conclusion, I would say. And so right now we are still at a very high level, as Beata correctly said, of tariffs, even after great unprecedented deal with the UK and China. The average US tariff is at, what, 18 percentage points, and it used to be 2 or 3 percentage points just a few weeks ago. So it's not great, but at least it's not 140%. And overall, we've seen a dramatic shift, talking about G7 economies, in how the global investors view dollar. Usually when you have panic, even if this panic originates in the US, like in 2008, 2009, dollar is the safe asset of choice. In recent weeks, and especially after the Liberation Day tariffs, we saw that investors started to view dollar bonds differently, and that is a huge source of uncertainty as well. But overall, indeed, we think about European economies growing at 1 percentage point per year, UK as well, US probably closer to 2 percentage points. But again, every day we wake up, we look at social media, learn something new, and all the model-based forecasts become obsolete.
Yes, I like your phrase, reverse course. That depends on having a solid plan in the first place, of course. It may not be that clear that you're reversing course. It's just not that planned. So,
I fully agree with that, and I think we still don't know what the objective of this trade war is.
Yeah.
What the US administration wants to reindustrialize the US, collect tariff revenue, just shut down trade deficit, walk away from dollar as a reserve currency. It's not clear at all what the strategy is. It's still not been articulated.
Mercantilism in some form. But it's hard to know what that is either, I think, in his mind. OK, tariffs, we've been talking about that a lot, Beata. So what is the impact of those tariffs as far as we can see at the moment across the EBRD regions? Which economies are being hit?
So the biggest impact is indirect via the German economy. As you may know, forecast for German growth has been lowered to 0% this year after 2 years of Germany seeing its economy shrinking. And this is, of course, lowering demand for exports from our countries, not only exports that are part of value chains, but also exports of, consumer goods, from refrigerators to food to exports of software. There's also a direct effect on exports from EBRD regions to the US. Before this policy changed, the average tariff faced by our countries was less than 2%. By now, it's more than 10%. Now, because many of our countries are actually quite distant from the US, the three most affected economies are Slovakia, Jordan, and Hungary. In the case of Slovakia, as you see on this chart, the direct effect would amount to shaving off almost a percentage point from GDP growth, and that's due to high tariff on cars. 5% of Slovak population works in automotive industry, so this actually can hurt quite a bit. Jordan is the second country that's most likely to be affected. It is a country where some of US retailers, such as Walmart and Target, have production facilities. Jordan exports garments to the US, and here the effect is shy of 0.5 percentage point. Finally, Hungary is likely to see substantial impact due to its exports of car components and electronics. Now, but note that these effects that you see here do not include the reciprocal tariffs that were announced on the Liberation Day and subsequently suspended. And strangely enough, Western Balkan countries are the countries that would face the highest reciprocal tariffs on the order of 30%.
It's all very Alice in Wonderland, isn't it? You have to believe 30 impossible things before breakfast these days, which, you know, as it shifts all the time. Beata, thank you. Just a reminder, by the way, you'll have a chance to ask your questions a little later on here in the audience. If you're online, remember you can go to Slido. The code is 2201242. You can put your questions there, pick the tab that says Rep 25. And just a quick word for the producers of this event, if you could bring me the iPad for the Slido, that would be fantastic. Disappeared from my chair in the interim, so yeah, it would be great to have that. Anyway, moving on. Jim, you talked exactly. Oh, the smoothness. Yeah, Jim, you talked to a few.
There he is.
Oh, marvellous. Thank you very much indeed. Like magic. You talked a few minutes ago, Jim, about the fact that these, you know, the polycrisis world, in effect, you know, things come one after another. How resilient do you think is the global economy to what are really compounded shocks? You don't even have a chance to recover from one shock before the next shock comes along.
It's remarkable. You know, when you were going down, touching on that earlier, and I knew this question was coming up, I was trying to think how to frame my answer. You know, in many ways, I'm shocked that the world economy isn't weaker than it is. When you sit back and think of what we've had thrown at it since 2008, really.
Yeah. It's like a boxer, I always think. You know, you hit the mat and suddenly the blows keep coming.
This is like Muhammad Ali. And you know, I find that this is just a conceptual idea, but it links to something Sergey said. You know, because of the interplay between what one might call financial conditions and the impact that those financial conditions have on the private sector, both in terms of investment and consumption. What appears to sort of happen is if a shock ends up influencing demand expectations more than supply expectations, and markets start to believe that Western interest rates will fall a lot, it sort of compensates a bit for the shock, and the vice versa. And maybe the markets sort of do that because it's just easier and it's harder to identify supply shocks until years after they've actually had their consequence. And it feels a bit to me that that's how this is playing out a little bit so far, because of course the big surprise with the high frequency data, not that I'm doing this 24/7 a day like I did for 30 years, but it's still in my veins. But if you look at the high frequency data, the real surprise is how well things are holding up.
Perhaps unrealistically.
Well, it might be because of this. You know, you've had a big easing in financial conditions, especially now that the equity market has recovered. The flip side of that, which is not an optimistic path to go down, is if the US is indeed rolling back significantly from where it implied it was going to be a month ago, maybe interest rates aren't coming down as much as people thought. And then you've got to factor all of that in. So I think you've got all these complex interplays going on in addition to the shock. But on this particular one, and I could talk all day about this, so I apologise.
I don't think we've got time for that.
No. You'll be very relieved to know that we don't. As I touched on earlier, at the core of the Trump insanity is something that I've sort of lived with for 40-odd years, where various US, usually the Treasury Secretary is more prominent about it than the President, but they're effectively trying to find a way of it. It used to be Japan in Asia, but last decade China, or last 2 decades, and always Germany, to do something more about their share to global domestic demand, and they never really have done. On this occasion, partly because of their own domestic stability, and also because after so many shocks, you know, how many shocks can Germany take? It feels to me like they're waking up and thinking there's a different path. And actually, I think that'll be a much better outcome.
Do you think it's
for
a
the
more
world.
self-sustaining path?
Yes, of course
because I
it
mean,
is.
that's the crucial thing.
Of course it is. If Germany is serious about shifting to a model where domestic demand is a bigger part of its economic life, that is just so much better for the EBRD region, without knowing any of the details. I mean, you know, what is it now? 12 years since I left Goldman. Even in the last 5 years I was there, I used to think the best leading indicator of the German economy was China. You know, which is like ridiculous for a country of 90 million people. And maybe that's beginning to change.
Just one final thought before we move on to Sergey. You know, I was struck yesterday, so all this euphoria in the market, but why should we be happy that we're, you know, not being punched in the face, but still being punched in the body? Because that's really what it is. You know, the tariffs have not gone away. You know, they're just going to be high instead of incredibly high, you know.
So I think I read somebody in the FT wrote this morning, dreamt up a very clever acronym that I can't remember now, but in essence, the markets now believe there's a Trump put. And so the next time, and you touched on it, next time there's something, the markets have a bad day, Trump will row back further. And that's sort of assuming there is absolutely zero logic to anything Trump's thinking.
So it's not strategic.
But, well, if it's right.
It's reactive and tactical, and if it's right.
You know, and I'll throw this one in as a provocative thing for you to contemplate. I met, coincidentally, last week with a very prominent US economic thinker of 4 decades ago, who is very fond of free markets. And he claims Trump is going to preside over free trade between everyone.
Okay.
I was a bit... I couldn't speak for the next 30 seconds. And I just looked at this guy and thought, you really?
But it's
can you imagine, given the uncertainty?
But also, can you imagine, you know, so...
Who knows?
I mean, I first met Donald Trump in 1988 when I was the BBC's North America correspondent in New York. And I interviewed him about property. It was the time when the Japanese were buying all the property in Manhattan, you know. And of course, at that time, he also had a great sense of grievance, but it was against the Japanese, not the Chinese. But even then, in 1988... I
was living in the States at the time. It was huge.
Yes, it was,
Grievance against Japan was huge.
In fact, my office was bought by Japan. It was Rockefeller Center, and the BBC office. And, you know, even then, I remember meeting him in 1988, and he talked about tariffs in 1988. So it's interesting what you're just saying, because that would be, you know, but again, I'm not sure he's always wedded to ideology. He may well be able to move away from it. He's not necessarily a convinced...
I should have touched on this, but you know, again, we might have a chance to come back to it. But you know, what he said yesterday about China changing its model, I mean, I'm not sure he's not the arbiter of that.
No.
But in the context of all the growth the world's had since the past 25 years, if China is itself going to seriously pursue more domestic demand, that is a massive positive for world economic growth.
Yeah.
If.
Okay. Interesting. Sergey, let me turn to you. You know, obviously one of the other major shocks to the global economy has been the war, on Ukraine. We are in another interesting week for that. We'll see whether some talks take place on Thursday or not. Even Donald Trump may turn up there, he says, if they happen. But what are the chances, do you think, of this really being resolved anytime soon?
So we definitely don't know what's going to happen even day after tomorrow, right, as you said.
Yeah.
I don't see Vladimir Putin going there on Thursday. I just think that you cannot prepare a visit of a person so paranoid and so concerned about his own security in a couple of days. But I may be proved wrong. Overall, we see that the US administration's converging with the EU leaders on the way forward, which is there is a deal on the table. We still don't have the exact parameters of the deal, but it looks like there'll be a de facto recognition of the front line of the separation line. There'll be no NATO membership for Ukraine in foreseeable future, and then some kind of truce. It's not going to be a peace treaty because Ukraine will never recognize annexation of its territory de jure. So this deal is on the table, and to force this deal, European and American leaders seem to have converged in a threat to Putin of secondary sanctions of or Russian oil buyers. Now, whether Putin is convinced that U.S. administration is committed to this course of action or not, it's a different question.
I'm not terribly convinced, I must say, that it's committed to that.
Yeah, that's a good question. But we see more and more negative noises from the U.S. administration, which probably makes this deal more likely in the coming weeks or months. But again, we wake up on Thursday and we learn from Truth Social that things have developed in some direction. It's just impossible to predict.
Doesn't it still look more likely, by the way, Sergey, that the key to the deal is Trump pressure on Ukraine? That still seems to be the main pressure.
I think what we've learned and what Ukraine leadership has demonstrated very clearly is Ukraine has very few arguments against Trump's pressure. EU can provide resources, but EU cannot provide certain military instruments, including intelligence data. And so I don't see any impact of what's called mineral deal. I don't think it's a very important document. It's been signed, so U.S. is now declaring victory on this for whatever reason. But I see that since end of February, this discussion in the Oval Office, President Zelensky has shown that he can try to stand up to Trump, but Trump has enough arguments to force him to converge with the U.S. position. Ukraine depends on the U.S. Military support. EU cannot replace U.S. in military terms. And so U.S. can incentivize Ukraine to accept the deal. But Ukraine also has a democratic civil society and democratic society in general. So certain things no Ukrainian president can accept. So President Zelensky can say, I signed this peace treaty, and he will be impeached next day. So certain things are off the table, and I think by now President Trump understands that, and he's been moving closer to the EU position on this. And I think what we saw a couple of days ago is extremely encouraging in a way that President Zelensky and European leaders called Donald Trump, and they discussed threatening Russia with further sanctions. And I think another argument U.S. holds now is providing more military support to Ukraine. This is a major threat to President Putin. So if President Putin sees that happening, that may actually affect his willingness to negotiate. So far, no change, but who knows what happens on Thursday.
Just one quick economic question on all of this. You can see a scenario, well, I'm interested if you can see a scenario, but you could see a scenario where there's some sort of ceasefire deal, not a full peace treaty, you know, for Ukraine. That then leads to some lifting of sanctions on Russia, particularly American sanctions. We'll see what the EU then does. You know, you get a falling oil price, energy prices as a result of this, and actually that then counteracts some of the impact of whatever tariff level we're going to end up with.
We shouldn't overestimate the impact of Russia on global economy. Russia is a very, despite the contribution of Jim to a global economic debate 25 years ago, Russia has not become an equal of India or China, at least China. So Russia is still less than 2% of global GDP. Russia is already supplying a lot of oil. And the whole idea of oil sanctions was not to remove Russian oil from the market, but to impose lower price or oil price cap on Russian oil revenues. So I don't think that's a major issue. I think the major uncertainty is whether the West gives Russian frozen assets back to Russia. And this is actually where Europe matters, not the US, because most of this money is in Europe. And I think that would be a huge mistake because somebody has to pay for Ukraine reconstruction, and it could be Western taxpayers or Russian frozen assets. And I think Western taxpayers are not very happy to see additional taxes to pay for the reconstruction. We talked about G7 economies, right? Jim correctly said that Europe now will have to pay for its own security and defense, but there is only one country which has fiscal space, which is Germany. Just to remind you, this country has increased defense spending from 2.3 percentage points of GDP to 2.5 percentage points of GDP. And to pay for that, this country reduced development aid from 0.5 percentage points of GDP to 0.3 percentage points of GDP. This, relative to Germany, neither UK nor France nor other developed economies have fiscal space to pay for this. And of course, I think this is the most important issue, not removing other sanctions, but the frozen assets, which at this stage are estimated at 300 billion. The estimate of Ukraine reconstruction demand is probably 500. This is the latest estimate from the World Bank. So 300 billion paying for this is a major part of the equation. Other things, I think, are not that important, neither for the West nor for the global economy. And I would say that talking about ceasefire, there are several gradations there. There is ceasefire, truce, and peace treaty. I think ceasefire is likely. Truce is very important. Peace treaty is not foreseeable as long as Vladimir Putin is in his office. But truce is not bad at all. Remember, South and North Korea still don't have a peace treaty. And they function, well, South Korea functions pretty well.
Yes, if only the UK functioned as well as South Korea. No, I mean, I certainly agree. I think we're the best probably will be what I describe as a hot ceasefire. You know, you can imagine an India-Pakistan line of control style peacefire where it flares up sometimes. Anyway, let's move on. Beata, let's come back to you. You know, we've talked a bit about some of the economic fundamentals. Let's look at inflation now. What's happening with that in the prospects?
So, over the last 2 years, we've seen a very fast process of disinflation, fast by historical standards. But in the last few months, inflation has actually ticked up. Now, the nature of inflation has somewhat changed. Initially, inflation appeared because of disruptions to supply chains, because of high commodity prices, particularly when the war on Ukraine started. Now, demand side factors are playing a greater role. We have seen very fast growth in wages, particularly in Central Asia, in Caucasus, also in Western Balkans. Now, what can provide some respite is oil prices. Now, you, Sergey, mentioned, and Jonathan, you were suggesting that there may be a change in oil prices. We already saw a drop in oil prices due to worsening prospects for the global economy. OPEC Plus increased quota. Now, perhaps the respite China is getting through the tariff suspension will lead to some uptick as the demand for commodities will increase. But overall, low oil prices are going to put a downward pressure on inflation. Now, Sergey was mentioning cap on Russian oil exports. Indeed, in the data, you see that Urals is trading at a significant discount relative to Brent. And that wasn't always the case over the past few years. Now, of course, not all the countries in our regions are doing equally well. Turkey is still fighting very high inflation, and that process is costly. High interest rates are putting brakes on the economy. And Ukraine faced a surge in inflation due to the destruction of power infrastructure and higher prices of electricity, particularly imported electricity. But the hope is, or the expectation is, that this inflation in Ukraine will go into single digits by the end of this year.
Okay, very clear picture. Jim O'Neill, you know, you're famous for coining BRICS. You know, you talked again all those times ago. You know, you talked a bit about the changing dynamics in China, maybe with domestic demand. But what do you think? You know, the EBRD is expanding into new areas as well, into Africa. What do you see all this meaning? You know, the BRICS and the future in terms of global balance of economic power. You know, clearly one of Trump's worries is it's shifting away from America, and he's trying to do something about that. But how do you see that evolving, and the BRICS role in all of this?
Another full day is needed for a comprehensive answer.
You've got 2 minutes.
You know, I sort of feel a bit déjà vu on many aspects of this. You know, this November will be 24 years since I thought of this strange acronym. And
Brazil, Russia, India, China, by the way, if anybody's forgotten that. So.
And it's, you know, I did it because it seemed to me what everybody's sort of talking about today was the reality back then. Other than most people didn't realise it. And there's multiple complexities that underpin it, but at the core of it is the WTO did not work well. Yep. I used to argue, I mentioned Peter Sutherland earlier, I used to argue with him all the time at Goldman, because he was always going on about these various great things that WTO was doing, but it never seemed pretty relevant to me for what was actually going on in the world. And it's true about many of the post-war institutions. And, you know, the BRICS countries turning themselves into a political thing, you know, as far as I can see, has not served any fruitful purpose other than symbolising how unfair global governance is. And so, if we can't, in the countries that created these institutions, allow them to adapt and evolve to include bigger space for countries that are becoming bigger, then they're not going to be as important. And you know, I thought 2008, 2010, with the advent of the G20, and particularly what they did in 08, 09, and a little bit in 2010, I thought, we've sort of developed a new way, a better way of dealing with all these different countries. But of course, partly because of personalities with President Xi, and certainly with the way the US has gone, it's kind of fallen apart. I'm not even sure if it's that possible to get a G20 meeting happen.
Yep. Well, certainly one with America attending anyway.
You know, which is such a sad state of affairs. But at some point, because it's so obvious that if you have better domestic policies, global trade is a win-win for everyone. At some point, we will have leaders that try to put that, something like that, or another version of it again together. But in the meanwhile, we're going to go on with this kind of world that's going where it is. And you look at the various, you know, the BRICS Plus, which is now evolving. Yep. So you probably know better, probably includes some of your countries, I'm guessing, these days. I'm sure it must do. And, you know, at the core of that, can you imagine a world where India and China actually ever did anything other than dislike each other? I mean, if they really got together, that could be transformational for aspects of global trade and governance, where the US wouldn't be as relevant. And it's final thing to say in that regard, as a provocative thing. It's quite. I was shocked when Trump started talking about the BRICS. I'm like, what the hell is he talking about? Well, ignoring the fact he seemed to think Spain was a member.
He got the S wrong, I think.
But that sort of does tell you on one sort of subliminal level that they are worried about this. But what else do they expect?
Yeah, and it's hard to know really whether that's that looks like one of the prime motivations for some of his actions, even if you can't always discern some of the prime motive of that worry. But it's but that's today. Sergey, looking at some of the countries and regions in the EBRD sphere of influence, if I could use that phrase that's very, very popular these days. How do you see Central Asia and the Caucasus economies? How are they positioning themselves in this new world? And actually, Central Asia, of course, and BRICS are on speaking terms.
Thank you, Jonathan. I think we are in a situation where trade war between US and China is still a reality, even after walking down to 10% or 30%.
Yep.
And countries which can trade with both sides of this trade war will benefit. And we already saw that, and Beata has done research on that, so it's probably a question for Beata, is that Caucasus and Central Asian countries have benefited from trade intermediation between Russia and the West after imposition of sanctions in 2022 and 2023. They, of course, some of those countries, of course, also depend on commodity prices, and commodity prices are coming down right now. That's why EBRD somewhat downgraded growth projections for some Central Asian countries. There was also a one-off shock, positive shock, when hundreds of thousands of skilled Russians moved to these countries. Not just with their human capital, but also with their money in 2022 and 2023. This shock was a one-off, so cannot deliver growth forever. So I think it is normal to see some slowdown after this positive shock. So overall, I think the most important issue there is, and this is not just Central Asian Caucasus, but also Middle Eastern countries, is whoever stays neutral in this trade war will benefit, because you can trade with both sides and be this trade intermediary. And I think this is something that is probably good news for those countries.
All right, thank you very much, Sergey. We'll be coming to audience questions in a minute. Another message from the producers. Slido has logged itself out of the iPad, so we'll see whether we get any online comments. Perhaps someone could come and deal with that. In the meantime, Beata, let's turn to the financial pressures which are on lower-income countries. What are they facing today?
Well, so after the pandemic, most countries emerged with higher public debt, which in an environment of higher interest rate means higher costs of debt servicing. And in this respect, the situation is particularly acute in Egypt, which spends 13% of GDP on servicing of foreign debt. And as you can see in the chart, Jordan and Ukraine spend on the order of 6% of GDP on debt servicing, and Hungary, Tunisia, Greece are other countries with significant expenditure. Now, what we have also documented in the report is that over the last 2 decades, our regions of operations have managed to tap more into borrowing in financial markets. So they borrow more in bond markets as opposed to bilateral borrowing. And that means that they are exposed to potential turmoil on the market. And while in this panel we talked about trade policy, right, a known unknown, there could be other shocks, some unknown unknowns that could cause turbulence in global financial markets. And if there is flight to safety, if investors choose to seek safer havens, that means that our countries may be exposed to that shock.
some of those figures are quite staggering, aren't they? Actually, the Egypt one in particular. Thank you very much. Right, it is 11:15 here in London. Why don't we take some audience questions? So put up your hand and we'll get a microphone to you while you're thinking about your question. We'll come to this gentleman in the front in a second. Good to see you, by the way, Ben. We will take an online question maybe first of all. It's quite an interesting one. Is Trumponomics a catalyst the world needs? Isn't it time the world charts a new course? Can we have radical thoughts on this? Trumponomics, Jim? In other words, he's shaking it all up, and doesn't the world need a bit of a shake?
Yeah, you know, I'm feeling, I got out of bed feeling optimistic today. I think that's...
I hope we've rectified that in the past 45 minutes.
I think that's the constructive way to think about it. I mean, it is the case that far too few big countries have contributed to domestic demand enough. And if a consequence of this insanity and volatile approach is to change that, then yeah.
Okay.
I'm not sure I'd want to be running, being a CEO of a major multinational right now, but
it's one of those things that you don't want to live through it, but actually maybe it's an interesting thing.
If it works, yeah, that's yeah.
Okay.
I think that is the only, the other ways of thinking about it are so pessimistic and worrying. That's the best way to think about it.
Sergey, what do you reckon?
Yeah, I think being in Europe, you see how Europe is waking up and trying to get its act together on so many dimensions, including on security, but not only. UK is getting closer to Europe, and in that sense, yes, US policies are definitely delivering a message that Europe should do more and better. Now, Trumponomics, I still cannot define, as I mentioned. I think,
I'm not sure he can define it either.
I think one piece we can see is being a Republican president, Donald Trump is very committed to lowering taxes, and he wants to pay it for this with tariff revenue. But we still don't see the numbers which add up. And US is running a huge budget deficit. It's actually bigger than a year ago in the percentage of GDP. And this is not sustainable. Beata didn't show us the US on that map. The good news, and I want to be optimistic as well, as I said, whenever there is a spike in policy uncertainty, bond markets are reacting with this, with increasing government borrowing cost for the US by 0.5 percentage point. That means in this map of Beata's, US goes up. And that means tax cuts are less likely, right? And in that sense, I think Trumponomics still has to face the reality of fiscal sustainability. But talking about other countries, being a European, living in the UK, I see how different the debate has become now. It's very different from 8 years ago. Remember, President Macron at that point said, NATO is brain dead, and was ridiculed.
Time for the strategic autonomy or whatever.
Talked about strategic autonomy for 8 years, and now people are trying to take it seriously. Most importantly, as I said, Germany has shifted.
Beata, what about a shake-up then? Is this good?
I think we need some shake-up. You know, if you think about this panel, we talked a lot about trade policy, but our countries, rather than complaining about factors over which they have limited control, they would do well focusing on what they can control. Think about, Bulgaria and Romania could more vigorously tap into the European funding, RRF. So far, they haven't tapped as much into it as they could have. Western Balkans could do more on structural reforms. In Egypt, the state could retreat from the economy, leaving more space to private sector. So in our regions of operations, there is a lot of scope for improvement in policies, from governance of state-owned enterprises to the financial sector. And all of these improvements could result or would result in faster economic growth.
Okay. Let's take a question from the audience. We'll bring a microphone down here. Give your name when you ask the question. Ben, you get the first question. But give your name anyway.
Thank you, Jonathan. Ben Harris, I'm the editor of BNE and Telenews. We cover emerging markets. My two-part question to all three of you. You talked a lot about Germany being very important, and of course it's been in recession, and 3 years, I actually live in Berlin. But the end of the Schuldbremse, the ability to borrow, this means they've freed up some 500 billion euros, which means we're going to have a huge fiscal stimulus, which is more than needed. However, this comes in the context of the Draghi report that was released last year, and there are deep, deep structural problems, particularly with Germany, but all of Europe. And although the short term, this money injection plus the defense spending is going to be good and lift Germany, which is good for the region, to what extent do you think that they're going to be able to solve these fundamental problems? Because they're lagging behind the States, they're lagging behind China, and the prospect of catching up is not very good. And specifically to Jim, as the man who coined the BRIC phrase, to what extent do you think there's a fundamental change going on here, in so much as I've been watching China, and in the last year or two, they've suddenly overtaken in solar panel technology. Now they've overtaken in EV. They just brought out a 5 nanometer chip, which they didn't think possible to do. They came up with DeepSeek, an AI that comes at a fraction of the cost. And I'm just seeing technological change after technological change catch up, which has been the West's advantage. And at the same time, the obvious consequence of Trump's tariff policy has been for everybody else to diversify away from the States. And this has been driving a process that already started within the BRICS, the G20, however you want to cut them up, of free trade agreements. The Eurasia Economic Union is active, the Shanghai Cooperation is active, Mercosur, ASEAN are getting active. And so we're not seeing trade tariffs in the rest of the world, in the developing world. We're actually seeing an acceleration of free trade. And to what extent do you think that there's, and this is the main thrust of the question, to what extent is there a fundamental change going on where the center of economic activity is moving towards the emerging markets?
Thank you very much, Ben. Okay, Jim, you start.
So I'll take the second one and a brief comment on the first one, but I was going to touch on it before. Beata and I were both actually participants in a conference hosted by Bruegel, the European think tank, with the Central Bank of the Netherlands recently. And I did it online, but what was striking to me was about the supply side reforms, and for European policymakers to really pursue aspects of the Draghi proposals and internal services sector opportunities more seriously. And that was a repeated theme, which goes to the heart of your question. So it seems to me that we haven't talked about that yet, but that door is now opened more than I think it was by this state of affairs. On the question specifically to me, you know, on one level, another way of thinking from 40,000 feet about all of this is that this is the US just lashing out because it's struggling to cope with the fact it can't be the dominant guy anymore, as well as the fact there is this relative domestic demand issue that's gone on for decades. And those two things sort of intersect. And I think the reality is it's very, very hard for any nation to preside over no longer being as big as it is to the rest of the world.
Struggled with actually after the Second World War.
As we struggled with. And that's what's really going on below it all. And so some of these things that you touch on about the evolutions of other countries in their own chaotic or unstable or unpredictable way getting closer, it's all perfectly logical. And I also attended a very small meeting of some ex-battle-hardened Treasury advisors here in the UK a few days after Liberation Day as to what the hell we should do. And what was clear is this sort of, let's call it the economic coalition of the willing towards lower tariffs with the rest of the world. I think it's very powerful, and not least because it's pretty logical.
Yep.
And I think, you know, Sergey touched on it about us and the EU, ironically, the trade grouping that the US set up with parts of Asia that they're not in, that's going to get a huge lift. And so all these things are pretty inevitable. And they should be happening anyhow.
Very good, Jim. Sergey, Russia's still struggling with loss of empire, of course. That's also part of it, but not about that. But the answer to this question is a big challenge for Europe, isn't it, actually, to get to this?
It is a big challenge for Europe, but let me comment on what Jim just said. The fact that U.S. share and the West's share of global GDP is shrinking is not a bug, it's a feature. It's the work of development communities, actually, to make the rest of the world richer and catch up.
Yep.
Right? And so the very fact that the West, the golden billion or whatever it's called, is just whatever 12-15% of global population, and this will not change, means that eventually, when we succeed in our development efforts, and the rest of the world will catch up to high income standards, that will be the share of the West's GDP in global GDP. And this is the reality. And if we don't get there, that means we failed in our development efforts. So just let's be open about this. The fact that China is catching up in terms of R&D, again, this is something that everybody wanted, right? We wanted investment in human capital and technology around the world. U.S. universities remain the top universities, top research universities in the world. But again, U.S. administration is fighting this very actively, trying to undermine research capacity of U.S. universities, which is very sad for all of us. Now, UK is not behind. We just talked about this.
Might be good for your current job.
Yes, but UK government just also announced that they will try to impose a 6% levy on international students coming to the UK, right? So Canada and Australia are also reducing those universities' capacity to attract international students. But anyway, I think that some of those things are actually part of development cause. So talking about EU, I think Draghi report is taken very seriously by member states and by the Commission. To what extent EU can actually get its act together? A lot of people are very skeptical about completing banking union, capital markets union. But once again, we are in a situation where EU is waking up. And we already saw in 2020 that certain things which we didn't believe were possible were actually implemented. The Hamiltonian moment, where EU suddenly agreed to have common bonds and put together next generation EU, which is a real thing. It's spending hundreds of billions of dollars, which brings some EBRD countries and some Southern European countries, which are not part of EBRD countries of operation, forward. This investment literally helped some of those countries to come out of pandemic-caused depression. So maybe this moment will also help EU countries to do certain things that Draghi report has prescribed.
Beata.
So let me continue with the theme Sergey mentioned, right? We are discussing 150 billion euros spending on defense. Here, the implications for Europe will depend on two trade-offs. The first one is, do you go for purchasing the best available systems versus do you go for sourcing systems nationally or within Europe? And when you buy within Europe, perhaps you don't get the cutting-edge system. Second is the trade-off between sourcing the best available today versus investing in development of future systems, so investing in R&D. And I think that's the opportunity, right? If a big chunk of that funding goes to R&D, Europe has a chance of boosting its competitiveness. I mean, in the previous RAP, we looked at the list of 100 companies with the largest R&D spending. And the picture was not pretty from European perspective. More than a third were American, a quarter were Chinese, only a fifth was European. While 20 years ago, that list was dominated by European companies. So now it is a now or never moment for Europe. And because there are many things on the table, capital markets union, deepening of the single market, free trade agreements with other countries, joint spending on defense, there is a hope that there is bargaining space and that agreement can be reached between various member countries.
Yeah, is this going to be Europe's moment? That'll be something we can discuss in a year's time when we all get together. We could have spoken all day, as Jim likes to say, but actually time has got away from us. And that is just about it from us. A big thank you to Beata, to Sergey, to Jim, and to you as well in the audience, and those of you online. Just a reminder, our latest economic forecasts are available on our website, ebrd.com. The audio version of this event is also available on Spotify, Apple Podcasts, other platforms. Thank you very much for being with us. Goodbye.